We have, is it NBD? No, it's Juma. Juma BD and Kazungu, casual employees of Suja Limited, are paid using the piece rate and hourly rate method respectively. So it's Juma BD is paid using the piece rate method. Now, the working days of the companies are from Monday to Friday every year, Monday to Friday. Now, the wages are paid at the end of the month and are subjected to income tax deduction, calculated according to the following schedules. So we have the monthly taxable pay. Now we have that one. So we have the personal relief also is given. So required, the net pay for Juma BD for the month of July 2008, given that it produces 300 units per day, assumes a 4-week per month. But they are working from Monday to Friday. And now it's producing how many units? It's producing 300. Now let's start by calculating that one for Juma. Juma BD. Now first we get the first to 50. Now there's something you must understand. That the first, when it's going to produce to 50, minimum units of to 50, is supposed to be paid 10 shillings per unit. Now, what is the maximum? The maximum to 50. They're saying the minimum units. I want us to get that statement clear. They're saying that for the piece rate method, an employee is paid 10 shillings per unit produced, as long as he produces a minimum of to 50 units a day. Production of any extra unit allows, above to 50 units is paid at the rate of what? 20 shillings per unit, up to a maximum of what? 20 units. 20 units. So what is the minimum? 50. Now, for the extra units, it's going to be paid how much? Now remember, it's going to produce the production, number of units produced, number of units produced per day equals to 300 units. So multiply here. Now, we are going to find what's the, because you're using the rate, what's the wages? Minimum units of 50 is going to be paid at what price? 10 shillings. It's 10 shillings per unit. So the wage, total wage will be equal to 10 times what? Times what? Is it times 250? Is it times 250? Sum of this statement? Want us to go together. Is it times 250? We repeat again. It's saying for the piece rate method, an employee is paid 10 shillings per unit produced, as long as he produces a minimum of 250 units in a day. Now, production of any extra unit above 250 units is paid at the rate of 20 shillings per unit, up to a maximum of 20 units. So there will be an extra again. So what is the minimum? What is the maximum unit for you to be paid 10 shekels? If you pay 250, if you produce 250, you are going to pay 10 shillings. You're together. Now remember that for this particular 20 shillings, if you produce an extra of what? 20 units. Remember this person produces how many units? 300. Do you know whether we are together? Hmm? 10 you multiply to 50. Yes. And how about the extra?
The extra is 50.
50 you multiply by what?
20.
20.
Yes.
What about see? Okay, 30 goes.
It's another 30, isn't it? The way they are talking, the way the question is, they frame the question. That question kuna kitu mbaya.
Kuna 30 goes wamesema.
Yeah.
Hii 20 go to akiwa ameikisa 20 so kuna 30.
Yes. So where is this 30 going to? Times 10. So the maximum here is going to be 8. What's up? We may produce what? Yeah. But they say so long as he produces a minimum of 250. They have not talked about the maximum. What's up? Yes. But for any extra, it's going to be paid at the rate of what? 20 shillings per unit. Up to a maximum of what? How many units? 20. Which means there is some units remaining. They have not accounted for that. How many units are there? 30. So we multiply this one by 280. To give us what? 800. To go out. So sorry, we multiply by 280. That's per day times 5. That is 5 days times 4 weeks. You got it? 56,000. Then we have extra unit. So we want to get the wages, which is going to be 20 times 20. Can you get together? Times 5 times 4. You got it? 8,000. Then we add, we get the total wages. $64,000. So that is the one you are going to tax. So after that, we are given the rate per month. So we are going to have the monthly taxable pay. Monthly taxable pay. And then the rate, and then the tax liabilities. Can you get together? Then, after that, it's from 1 to 10, 164. So that's going to be 10, 164. You multiply by 10% to give us this 1,000. 6 point what? 4. Goes out.
Yeah.
The next, we take this 10, we take 19, 740, subtract 10, 164. Inakupatia ngapi? 10,000? Inakupatia 95.76. 95.76, like that.
Yes.
We multiply by what? 15%. 1436.4. The next one is 95.76. We multiply by 20%. No, just subtract. And it's going to be the same value. You take 29,316 minus 19,740. You got it? 95.7 divided by 20%. 19, 15. 15. 1915.2. Then that is the salary is still less than 65. The next one, 38,892 minus 29,316. You got it? 76. We multiply 25%. 2872.8. Excess. How do you get excess? We take this 64,000, we subtract 38,892. Ngapi? 25? 108 multiplied by 30%. $75.4. We add, we get gross tax liabilities. Okay, let's get the total. $14,000. 77.2. Then we less personal leave. Now we are given the personal leave, Lingape. 116. Then we get, we don't have insurance, we get net tax liabilities. $13.2. Then they want you, after that, that is the tax payable. They want you to calculate for the net pay for Juma. Given that he produces that per day, assume 4 weeks. So for you to get the net pay, we write the net pay will be equals to 64 minus 13,611.2. Net per 50. 388.8. Okay, any question there? Now let's go to the next one, the net pay for Tumaini Kazungu for the month of July 2008. Given that he worked for 10 hours per day. He works for 10 hours a day. Now, let's look at this one for piece rate, not piece rate 2. This is for Kazungu. So first, we are going to start by computing for the basic pay. Basic pay will be equals to 8 hours, the time you multiply by the wage rate. The hours multiplied by the wage rate. So 8 times what? What's the wage rate? 250. It's going to give us 2,000. Okay, times 5 times 4. 5 is the number of days in a week. 4 is the number of weeks. They're together.
40,000.
40,000. Then overtime. Overtime is going to be 2 times 400, yeah, times 5 times 4. 16,000. Then we add to give us what? 56. Then after that, we compute for the wages.
So we are going to have the monthly pay, monthly taxable pay. You're going to have the rate. You're going to have the tax liability. So remember we have 10, 164, 10%, which is going to give us 1016.4. The next is 9576, 15% to give us what? 1436.4. The same 9576, 20% to give us 1915.2. The next one is 9576, 25% to give us 2872.8. Now excess. We take 56,000, subtract 38. Yeah. $70,108 multiplied by 30%. Okay. Got it? Got it? Got it?
John 32.
We add, we get the gross tax liabilities. Twelve, 30, 47, 3.2. Then we less personal relief. is going to be 1162. We get a net tax liability.
Eleven.
Point so. Then we get the net pay, which equals to 56 minus 11 to 11.2 to give us 44, 7, 88.8. Sandra?
Now, let's continue with what's known as the hire purchase. Hire purchase. Now, you're going to find that sometime you want to buy the commodities, but due to the inadequate finances which you have, you cannot manage to buy a commodity on cash basis.
Excuse
Yes.
me. About this.
Then,
About this question.
what
if the amount you fund kama hourly rate umepata 56,000 let's say umepata less as in itafika excess
You just multiply hourly rate.
Kama ni
Hourly
or piece na iko excess sema kama ilikuwa hapa between 20% ifike kama 15.5.
When you
So
talk
that's
about this wages, umefika maybe instead of 64, maybe it's 27,000. So the first one you compete 10%, the second one is just 15% because still less than 27. Then you take that 27, you subtract that. It was, what's the second rate? It was 30, the second, the third one is 29?
316.
Yeah, 29, 316. Assuming that that particular amount is less than 29, 316. Then you take that, maybe it's, let's say it is 25 or 27. You take 27, you minus that value from the second one. Then that difference, the one you're going to multiply by 20%. Yeah, together. Now we can continue by hire purchase. Now I try to explain with this hire purchase. Now you're going to find that maybe you need a certain product, assuming that you want to buy maybe a sofa set or you want to buy a computer or TV, etc. But you don't have enough money to buy. So we have two ways on which you can buy that particular items. One, you can either buy the items on a credit basis. Now, on a credit basis simply means that the owner of the firm is going to give you the product and the ownership will pass to you. And then you need to pay the whole amount at the specified date, which you agreed on together. Now, in case you defaulted, it's going to be very hard for the ownership to recover that particular amount. But when it comes to the hire purchase basis, it's where you are going to buy the goods and then you pay you pay a down payment. That's known as the deposit. So after paying for that particular deposit, so you agree on the period on which you are going to settle that particular amount. Now, in the credit sales, there will be no any additional amount charged. I hope you're getting that right. But when it comes to the hire purchase basis, there will be an extra amount which you must pay because of delaying paying for the product. That particular extra amount is known as the hire purchase interest. I get the point. So in case you buy and pay on a cash basis, then assuming that you're supposed to pay the cash price or the item is 20,000. So on a hire purchase, they must add an interest on top of this particular cash price. Maybe they can tell you that you're going to pay what? 25,000. So this 5,000 is going to be the hire purchase what? Hire purchase interest. So you continue by saying, under the hire purchase system, the buyer agrees to pay for the commodity. The buyer agreed to pay for the commodity. In installment. So I continue. On signing the agreement, the buyer can take possession of the commodity. And use it. But the ownership in the articles rests with the seller. Until the buyer pays the final installment. If the buyer fails to pay any installment, the seller is entitled to take back the article. And the buyer will have no claim over the installment. He has already paid. So it means that when you are paying for the product in installment basis, and then you fail to pay maybe the third installment or fourth installment, then the owner of the property, that is the seller, will repossess that particular product. Then you are not going to claim any installment paid by you. So that particular installment is going to be taken as the charges of the services you receive from the item you are together. So you don't claim it. So you continue by saying, higher purchase price is always higher than cash price. The difference between the higher purchase price and cash price is called higher purchase price and cash price is called higher purchase interest. Higher purchase interest. Now, just want us to continue. I want to explain again. Now, remember I said that when you're buying on a higher purchase basis, then you must pay for the first payment you are going to make in that particular firm is known as the down payment, or we call it the deposit. So you continue by saying, in the case of higher purchase, the first payment is called deposit. The first payment is called deposit or down payment. The monthly fixed payment are called monthly installment. The monthly fixed installment are called monthly installment. Now you're going to look at example. I want it to go to November 2017. November 2017. Question 2. November 2017, question 2. Question 2A. It says the cash price of a washing machine is like 80,000. You're seeing that. So we have the cash price equals to 980. Then a buyer pays a deposit of. So we have the deposit. It's going to be 255. Then, and pays the balance in 8 monthly installment. 18 monthly installment of 51,000 each, with a final payment of 46,000 together. So the monthly installment is going to be is what? 51,000. And then we have the final installment. It's going to be final installment 46,000. So they want you to the amount of money the buyer would do what would save by paying the cash price. So what we do? Let's get the total. Let's get the hire purchase price. So first we have the monthly installment is 51 for 18 what? 18 months. Yeah. So the total installment will be equal to 51,000 times 18. Senior. Plus 46,000. 964,000. Then deposit is how much? 255,000. Then higher purchase price. Ingapi?
It's 12,190.
Yeah.
Then savings. Savings will be equal to higher purchase price minus cash price. That's going to be 1,219 minus 980. Give us how much? 1239. Sorry, hapo.
Yeah, to go to November 2020, 2010. Question 2C.
Yeah. It's Mary. It is about portioning. Yeah. So Mary Mutisha bought a portion meal on hire purchase with terms. The cash price of the portion meal is 1,200,000. The hire purchase terms comprise a deposit of 35% of the cash price and 12 equal monthly installments of the balance and interest payable. Simple interest is charged on the principal's balance at the rate of 12.5% per annum. So required the amount of each monthly installment. Ulichupa fundamental jana, nilikupatia wewe, uko na nusu ama uko na full? Anza kidogo. Okay, let's continue. Umefanya majukumu. Umeweza? Nasema, I raised that question. It is Mary Mutiso bought a portion mill on hire purchase term. The cash of the portion mill is 1,200,000. The hire purchase term comprises a deposit of 25% of the cash price and 25% of the cash price. That is the deposit. We are together. Now, 12 equal monthly installments of the balances and interest payable. Simple interest is charged on the principal's balance at the rate of what? 12.5% per annum. That is November 2010. Question what? Question 2? 2C. Now, what you are going to do, our first step, we are going to find out what is the deposit. So because we are given the cash price, which is going to be 1,200,000. Now, in hire purchase terms, so we calculate for the deposit. Deposit will be equals to 25 over 100 times 1,200,000 to give us how much? 300,000. So that is going to be our deposit. So what is the principal balance? Now the principal balance will be equals to the cash price minus the deposits. Now the cash price here is 1,200,000 minus deposit, which is what? And that's going to give us what? 900. We are together. So this is the amount supposed to pay. The principal is supposed to pay. Then it's going to be charged an hire purchase interest using the simple interest. So the hire purchase interest will be equals to 12.5 over 100 times what? The principal. That's going to give us 122,500. So after that, 112,500. So we want to get the principals to be paid. So remember, we want to get the total, the installment payable. I get to the point. So the installment payable will be equals to the principal plus the hire purchase interest we divide by the number of periods. Let's look at this. It's supposed to be paid for how long? It's a monthly installment. It's a monthly installment. So that's going to be 900 plus 112 divided by what? Divided by 12. You got it? 84? 375. Swali hapo? Question? Hapo we are together. Going to look at another one and then proceed. Oh, this B. To switch here. B. Okay, B. The amount of savings, if any, that Mary Mutiso would have made if she had paid a deposit of 45% of the cash price and was charged simple interest of 10% per annum. So let's look at, we have saving, we have higher purchase price remaining constant, 1,200,000. Then we are going to have the deposit. It's going to be what percentage? 45%. So we take 45%, multiply by 1,200,000 to give us how much? 540,000. Then after that, after getting the deposit, then you are going to have the principal balance, which is going to be the cash price, which is 1 million minus 540 to give us how much? 660,000. Then after that, we calculate for the higher purchase interest. That's going to be 10% times 660,000 to give us what? 66,000. Then we get the installment. Okay, they want us to get the savings, yeah. Okay, if they want us to get the savings, now, if they want you to calculate for the saving, then that there's no, what we do, we just get the total, we get the higher purchase price. Higher purchase price will be equals to the interest plus the deposit plus the principal balance. We are together. And that's going to be interest is 66,000. We are together. Plus the deposit, which is how much? 540,000 plus principal balance, which is what? 66,000. To give us how much? $1 million. $1 million.